Welcome back. Shares of Tesla, as we told you, are under pressure. There's the stock down by 4.5% after the company reported its first decline in annual deliveries and a fourth quarter number that substantially missed expectations. Let's find out more from an expert. Tom Narayan is lead global autos equity analyst at RBC Capital Markets. Tom, thanks a lot for joining us. How should we be understanding this Tesla news? Is the Q4 miss as large as the market believes it is?
Yeah, I think it may be a little too much kind of overanalyzing a number. I mean, it was still up year over year. It just wasn't as strong as folks were expecting. What 396 was the number. I think expectations were, actually, sorry, 496 expectations were at 508. And I think the investor base, the buy side community, was expecting a 520 number. So it was more about expectations were very high, but the number was still fairly strong. And we have to remember, put everything in context. This is Tesla. So the car business itself is a very small piece of, I think, why people are in this stock. The other thing to take a look at is the energy storage number was huge, 11 gigawatt hours. They did 15 on all of 2023. So they did 11 in just one quarter and 15 in all of 2023. So, I mean, the stock is down, like 5%, which, I mean, for big market cap like this is a big number. But remember, it's been up like 34% since the election. So I think folks are putting it in context. It's definitely maybe a disappointment and to some degree, but folks who are investing in Tesla are in it for other things, autonomy, other things, rather than selling cars.
With that reminder and caution in mind that there's more to Tesla, a lot more than electric vehicles. I note in reading your forecast document for this year that you believe the electric vehicle slowdown, which is a big concern, I think, for investors, should reverse in 2025. Tell us more about that call.
That's absolutely right. I think Tesla actually could be a beneficiary of a reversal next year. They have an affordable car that comes out. Remember, they've been selling the same Model 3 and Model Y for years now. They finally will have a new model that comes out in the first half of this year, 2025. Happy New Year. And it will be affordable. I think they say it's going to be a sub $30,000 car. Potentially, it could look completely different, maybe utilize some of the aesthetics from the Cybercab that they unveiled in October. So that could be a catalyst. And that's half of all U.S. EV sales is one company, Tesla. And then in Europe, there's this EV regulatory cliff that's there. That's forcing companies to sell EVs. And they're going to come out with lower priced cars, too. So we think there could be a recovery, actually, in EV sales in 2025. How
much of a challenge is it for the U.S. and European EV makers? How challenging is the Chinese environment where you will know better than I will, but the government looks like it's subsidizing the domestic EV industry in a big way, and the domestic EV industry is grabbing huge market share in that big market?
That is definitely a big headwind, notably for some of the European companies, European car companies, mostly German, who are selling cars in China, the German OEMs. That's been a big headwind. It'll probably continue to be a headwind. The other thing that's happening is because they're overcapacitated in China, there's an incentive to sell those EVs into Europe. I think that'll take some time. They'll need to build production in Europe to do that. I'm not too worried about the U.S. there, the Chinese competition of EVs, more of a threat to the European companies, and definitely within China, that is really where these Chinese companies are gobbling up market share.
Okay, let's go to a couple of stocks that you like. You've talked about Tesla already. That's one of them. General Motors is another one.
Yeah, so I mean, this is something, it's more about not liking the other names. So kind of a process of elimination to some extent. You have, several, Stellantis is notorious for this. Now Ford, it looks like, with high dealer inventories in the U.S. That's because of really high pricing. GM's dealer inventory position is actually quite healthy. And they've been kind of retrenching. I think they're pulling away from China, which is a smart move. They're not investing into Cruise, the robotaxi initiative. They're buying back a lot of stock. So it's really more to do with them being healthier than the other companies, as opposed to us like really kind of pounding the table on that stock.
Okay, we'll finish with Ferrari, certainly a well-known brand to be sure, and it's rolling out an EV plan sometime this year, correct?
That's right. This stock has pulled back a little bit, actually, and I think it could be an interesting opportunity because that stock it rarely pulls back. It's such a high quality name. So at the end of this year, 2025, we will finally get the unveil, I think, of their new electric vehicle, which will launch in 2026. There is some concerns of an air pocket that we have in the first half of this year as their Daytona, which is their super high price limited edition car, that life cycle ends. But there's some new models that are coming in that I think people are underestimating that they're selling now that I think offsets those declines. And I think EVs will be a big story for Ferrari. It'll allow them to price those above their average pricing and actually expand volumes. That's something that, an exclusive company like this doesn't want to perhaps, expand volumes too much. But if they're selling a different type of car to a different type of consumer, it could allow them to expand volumes. So it becomes a growth story more than anything else.
Tom, thank you so much for your insight. That's Tom Narayan, lead global autos equity analyst at RB.